Ladies and gentlemen, welcome to another edition of In the Pit with Lobo Tiggre. Our victim of the day is a little bit unusual. It's the famous legendary investor Rick Rule, Sprott Global. Normally, I'm talking to a guy with a mining company. It's easy to poke holes in their business. But this is a different kind of business, so I have questions in mind for Rick. But before we get into my evil questions, I thought I'd just go ahead and get a market take from you, Rick. Everybody knows who you are, everybody knows more or less what you do, but what they really want to know is, where are you deploying your capital now? What are you excited about in 2019? Where are you investing?
Well, it's a great time to ask, actually, because I'm beginning to deploy fairly rapidly again. And I think for the purposes of most of your viewers, I can simplify it by saying I'm really doing three things. We foresaw, mercifully, the boom in mergers and acquisitions, which is beginning to take place. And so we have a mergers and acquisitions theme that takes two different strategies in mind. We have been deploying capital in companies that we think in the next 18 months will be the subject of takeover bids. Companies where the asset is strategic to a different company for reasons that we can understand. Companies where we believe that there is an unanswered question that keeps them from being taken over that will be answered within the next 18 months. Right. But importantly, different than everybody else is doing, we are also actively trying to find teams that will benefit from the divestiture cycle. In prior mergers and acquisition periods, what I've learned is that the really good company builders can use the assets that are sloughed off from the major mining companies in mergers, assets that didn't make any difference to a $10 billion company, which can make an enormous difference to a $100 million company.
Right, right.
And this goes to the strength of Sprott. Identifying management teams, being able to employ debt if that's what's needed, being able to deploy and raise capital for people. So we're playing M&A from two different points of view, which is attractive. The second thing I'm doing with my own money is I'm increasing an already fairly large position in royalty and streaming companies. Many commentators say that the royalty and streaming companies are overvalued compared to the rest of the market, which I disagree with.
Well, I think the risk profile is so completely different.
Very different, but I also believe that if you add back the margins, the operating margins between both styles of companies and the lack of sustaining capital investments, that the royalty and streaming companies are in fact undervalued relative to the risk-adjusted net present value of the assets going forward.
I thought you were going to say the optionality, because you usually get the royalty on not just the mine in hand, but the whole property.
You get the optionality for free. The optionality may be higher on the operating side, but the risk is so much lower on the royalty side, I'm willing to give that up. The surprising thing about the streaming companies in particular that I think other people don't understand is the market's perception is that the growth in the streaming business is behind us, that the big transactions have taken place, which is wrong. The growth is in front of us. It's in front of us for two reasons. There is an incredible demand for project financing for non-investment grade companies, a business I'm in every day. And the streaming companies play an increasingly important role in that. There is about $10 billion in finance annually in non-investment grade mining project finance, which means that there's probably a $3 billion a year opportunity for the streamers that the market doesn't recognize. Secondly, the mergers and acquisitions activity that we're seeing now will, as we discussed earlier, result in $12 or $14 billion worth of divestitures over the next 2 years, which need to be financed. So there's the opportunity to deploy very large amounts of capital in the streaming space with companies that have access to very large amounts of capital with very, very predictable results. So this is something that I think over the next 5-year time frame, which I realize is 10 times the time frame that most people employ, will inure decidedly to my benefit. The third place...
Sorry, before we go on from that, let me jump in, because this is something I've written about, that there's sort of a double-edged sword here with these divestitures. You have these major miners buying each other up, gobbling each other up, and they're going to take the best mines, get rid of the bottom 20%, 80-20 rule, whatever it is. And that can be good or bad for the junior. If you're a junior partner and they give you back something they spent a bunch of money adding value to, and it's a great project, just not big enough to move the dial for them, great. But if you're a junior that has maybe a more marginal project, that this major spending was your only hope of seeing work advance, and now that's gone, well, you're SOL, because nobody else is going to jump in and save you. So presumably you have a whole team of geologists and analysts sorting the wheat from the chaff there. I mean, not everybody who gets a project handed back is going to be a good investment.
With the caveat, of course, that we're going to get a few wrong. That's the nature of the business. If you are in this business and you don't accept mistakes as a cost of doing business,
yes,
you're in the wrong space.
Yes,
but we're looking really at a different place in the context of M&A. We aren't looking in M&A so much at the exploration side as we are the sort of Ross Beatty's and Oxygen Capitals and Amir Adnani's of the world.
I understand.
I remember in earlier divestiture cycles or in earlier market bottoms, little companies like Lumina Copper were made, where Ross Beatty went out and bought 7 properties. I think he spent $30 million on 7 properties. He probably spent $80 million beneficiating them. Then he sold them for $2 billion too. This is the point in time where projects that don't matter to Newmont or don't matter to Barrick are available to companies that are smaller companies and can double or triple the size of the company in 2 or 3 years. This is the heart of what Sprott has done well for 30 years, and this opportunity is being handed to me mercifully while I'm still active.
And so I just got to jump in again, and I know you were getting to your third thing you're deploying capital on, but this strikes me is because this is the time where you make the money, right? The buy low, sell high. We all know it. But people don't want to do it. People don't want to buy low. They don't want to hear about it. Oh no, the resource sector is terrible. Oh, gold's still doing whatever, you know. How do you convince your clients to buy low with you?
I've been in business long enough that I have a core of clients who have been with me for 20 or 25 years. I had a client the other day say, "You know what, Rick, I'm really sick of the sector." That's really bullish, isn't it?
That's right.
It's kind of funny. Now, the truth is, and this is going to sound very, very ugly, and you'll get hate mail for this, I'm 66 years of age. This is my last cycle. As you know, I don't spend any money, and I have a lot of it. So if the clients want to come with me, that's fine. If the clients don't want to come with me, that's fine. The fact that most of my younger competitors, who at least ought to have more energy than me, strangely, they seldom do. The fact that they don't want to compete with me at a market bottom, I find an unalloyed good.
Yes,
there are a lot of people in the business who are very smart, maybe not so hardworking, but very smart. And the fact that these smart young people unilaterally disarm in a battle of wits, now that I'm 65, I'm 66, pardon me, I think that's wonderful.
I understand. Okay, so let you get to your third point.
The third thing is that the industry has both underinvested and misinvested in exploration, I would argue, since 1995. So we've had, by my count, really substantial period of time of underinvestment and malinvestment in exploration. I talk to all the major mining companies and the mid-tier mining companies constantly, and one of the things they tell you, candidly, publicly, is that their exploration pipeline is underfunded. They've been underinvested. And the juniors, which are supposed to do exploration, have done market-related exploration for 20 years. They've been exploring for drill holes that excite investors as opposed to exploring for deposits. So generative exploration is something that has worked out very, very, very well for me. I'm in the most boring part of it, the process part, the prospect generators. Right. I do it because my statistical track record of success in that business is 3 standard deviations better than covering the waterfront. One of the things I've learned over time is that if you're involved in a process which is more efficient over time, although it may bore you, in a business where the expectation is boredom, where the expectation is failure, boredom is high praise indeed. In truth, in the prospect generators, I've told you this before, in 65 or 66 starts, I forget how many I've had, I've now participated in 21 economic discoveries and takeovers. So that means in 65 starts, I've had 21 wins. If you juxtapose that with the fact that
the overall number, I mean, 1/3 of the time is fantastic compared to the...
Apparently 3 standard deviations better response. Not 3 times, 3 standard deviations better. So why would I vary from that? Silly.
So, but this is really interesting to me. You and I, we have clients, right? And they're not always as patient as you are. And I get the prospect generator model. In a basket of those, you never know which one's going to nail it out of the ballpark, right? But one makes up for everything else. But that could take years. Right. You have clients that are patient enough to see that through with you?
Many. Most aren't. We've talked before about performance dispersal curves, Pareto's law, as it relates to management. It relates to investors too. Sprott, if you include our passive products, we have about 200,000 customers worldwide. And I wish it wasn't this way, but 1% of them, 4,000, are going to make 50 or 60% of the money made the next cycle. Should it be different? Yes. Do I have clients who are personal friends of mine who I wish understood the way the business worked as opposed to a way that's psychologically convenient for them? Of course. Is it my fault? No. You know, people are responsible for their own fortune. People who don't understand their investments, people who don't have a reason to invest in a company, people who conflate the concept of price with value,
right,
are people who are not going to be successful investors. Those people have trauma holding stock over a long weekend because they don't understand why they own the stock.
So this is actually something I've wondered about, and you know, you're in the pit with Lobo Tiggre, so I got to ask, you know, you're the great, mighty, legendary Rick Rule, the investor. Does your typical client see the kind of success rate that you do? You know, what's the return on investment for your typical client?
Unfortunately, securities laws preclude us serving most of our investors. Most of our investors are protected from themselves by the government, which is to say that the very best work I do involves private placements. The very, very best work I do involves finding very high quality people, placing capital with them privately rather than the aftermarket, and getting a warrant. The government, in their wisdom, has said that most investors aren't allowed to participate in private placements. So with regards to many investors, those people who the government doesn't regard as being big enough, old enough, and ugly enough to look after themselves aren't allowed in very perverse fashion. The government protects them by lowering their reward for the same amount of risk. I know I don't have to give you any lectures about the efficacy of government, but in direct answer to your question, the non-accredited clients, the clients that don't have million-dollar investment portfolios, unfortunately, don't have the same level of benefit that I do. On the other hand, those customers who are accredited, identify themselves as accredited, and ask to participate in the deal flow with regards to private placements, get more benefit than I, because at Sprott I'm last in line, which means that if we have $5 million to place and we have $7 million demand, Rick Rule's allocation is 0. I benefit indirectly because I'm always the largest investor in our partnerships, which means that the partnership is allocated some, and so I get it indirectly. But in direct answer to your question...
That's interesting. I didn't know that. When there's a private placement opportunity that you guys facilitate, the customers come first.
Every time. I'm last in line. The last 3 private placements that we've done, we've been an average of 3 times oversubscribed, which meant that my allocation was bumpkus.
All that hard work. Well,
you know, I'm not, as you see, I haven't missed a lot of meals, so it's okay.
Okay, all right, so we have 3 areas, and we've talked a little bit about the customers. Thank you for the candid response. That's very interesting. I wondered about that. You know, is it really as good for the customers? And the answer is, for the right customers, yes. So know thyself, potential customers. I would say the same thing, actually, for my business. 3 areas. Are there any? I'm not going to ask you, you know, to predict interest rates tomorrow or the price of gold next week or whatever. But are there any particular commodities that you're particularly keen on this year?
You know, I think that the best performing commodity, at least the commodity that will generate the best equities performance, is gold. I may be wrong. It may be silver, but I think that the precious metal stocks are never cheap. They're just less overpriced right now. That's as good as you get. You never get cheap in the gold space, but they're less overpriced. And I think that gold as a commodity has reasons to do well. I'm not saying it's necessarily going to do well, but I think it has reasons to do well. If past is prologue, I don't know if it will be. If past is prologue, gold will lead, but silver will go further.
Yes.
And we both know that there's a shortage of silver stocks. Even bad silver stocks.
Yes, yes.
But there's a real shortage of good silver stocks, and so that would certainly be attractive. I also, although I can't talk to you very much about time because I'm no good at it, I believe that we'll have a circumstance in what is left of my career in the uranium space that'll take people's heads off. I remember the last time, as you know, with some fondness.
Yes.
I don't think that this market will be as dramatic as that market, but the fact that you could compare the two means it's going to be fairly attractive.
Yes, indeed. This just came up on the Twitter feed. I'm remembering fondly Palladium, which was in the portfolio back in my Casey days, which went from a penny. You averaged down sub-penny, and it went to $8 and change. So just
$10, thank you.
Thank you. All right. So, well, was that Australian?
Yes.
So, you know, of course, not everything's going to be a Palladium. That didn't happen overnight.
Right.
But it tells you something about what's possible in that space.
Listen to this, Lobo. At the beginning of that market, there were 5 uranium juniors in the world. Okay, 5. Nobody wanted to be involved in a material that hadn't moved for 20 years, and people disliked it even more because they thought about Chernobyl, 3 Mile Island, Hiroshima, and Nagasaki. The worst of the 5 went 22 to 1. So let's not talk about the best. The worst of the 5 went 22 to 1. Interestingly, at the end of the cycle, when the uranium price didn't have to go up, there were 500 companies in the uranium space. Now that was interesting too, because that goes to bull markets. After a 20-year bear market, there were probably 10 teams that could function in the uranium space. So the probability
that 500 companies would have competent people.
Yeah, I mean, the probability was dividing 10 by 500.
Yes, yes.
It was truly, truly, truly silly. People couldn't wait to get into a sector that had it.
Yes.
It's a wonderful business if you think of it in that context.
Buy low. Don't forget to sell high, please. Okay, I got to ask one more on this because you know, I've had to eat a little crow on this. You were right about Palladium, or at least this year you were. Right now, Palladium.
To wait long enough.
Yeah, well, Palladium prices are, well, I don't rehash the whole thing. But I'm surprised that Palladium prices did as well as they've done.
Right.
Palladium is still more per ounce than gold right now as we speak. And I get that there's a supply crunch at the moment, but I also know that it's replaceable. It's easily replaceable. And it's there because it replaced platinum. You know, that could easily be reversed. So I just can't see this being sustained. On the other hand, that does take time. Are you still bullish on Palladium for this year, or is it already, you know, that's enough, this is a profit-taking time in that space, or how do you see that?
In terms of the metal itself, I still own some Palladium. I agree with you that what happened is that Palladium got too cheap relative to platinum. And so people developed fabrication technologies that favored Palladium. When you put fabrication technologies in place, the switch back to platinum is simple, but it takes time, like 3 years or 4 years or 5 years.
Terry, you know that for a fact, because I understood, you know, we're talking about these honeycomb matrices that you put this strata on top, you deposit it, right? And it's one metal atom versus another that's being deposited on this. Is it really that different?
The investment in fabrication tools and technology takes time.
Okay.
It took time for Palladium to replace platinum. It'll take time for platinum to replace Palladium. The thing that I'm worried about, Lobo, and well, you wouldn't, but I don't want your viewers to confuse me with an economist, but I'm nervous about a circumstance where a 9-year-old economic recovery, partially in my view driven by liquidity, falters, and that demand for everything, but particularly automobiles.
Right, so you're not worried about the substitution in the near term, but say China's auto sales declining, or
U.S. auto sales. You know, let's talk about the world's mouth. In commodities, everybody looks to China, you know, but they forget about the world's mouth, which is the U.S. And I'm not saying, I'm not one of these classic gold bugs that says, you know, we're headed into the Greater Depression or anything like that. But if you took 10%, 12% off auto sales worldwide, you'd hurt both platinum and Palladium.
Sure.
Of course, everything's nuanced.
And what about the sharing economy too? Like, what if the overall economy is fine, but you know, millennials apparently don't buy cars? Like, why bother? I can go Lyft and Uber. And if a whole generation isn't going to buy cars, what does that do?
It hurts.
Right.
It hurts.
Very interesting.
It hurts.
Okay. Well, this has been a great conversation. Any last words you want to share for us? You know, we're at the beginning of 2019.
Yeah, I really do, actually. I've been through a lot of interviews in the last 3 days, and a couple things have sort of struck me at night when I've gone back over the advice I've given. And the advice is really 3 things. Invest in yourself, first of all. Invest in your education. The fact that Rick Rule likes something is interesting, except you're not Rick Rule. So develop your own technique, your own style, your own valuation methodologies. Always understand the reason that you own a stock, and if the reason goes away, sell the stock. Don't worry too much about the price. Don't confuse price and value. The stock quote is only of use to you if you have an opinion as to value. It's only the delta between the price and the value that matters. Yeah. Nothing else matters. And the third thing is have realistic time expectations. When I think back over the money that I've made speculating, most of the money has come from very large moves in a few stocks. 10 baggers, 20 baggers, 30 baggers, preferably with warrants. And when I look at those outsized examples, I note that they've taken me 4 years or 5 years or 6 years. One thing that will amuse you, Lobo, because he's a friend of yours, when I look back at the success that I've enjoyed over 3 decades with Ross Beatty, 12 companies, only one didn't go 10 for 1. Each Ross Beatty 10-bagger I enjoyed fell by 50% twice during the period of time I owned it. If you don't have an opinion as to value, the price action will scare you out of a stock, and you will surely snatch defeat from the jaws of victory. Lumina goes to $4, goes from what, $2 to $4, back to $2, shakes out everybody on the way to 160.
Right.
People who didn't have an opinion as to the value of Lumina and got their information based on price, got shaken out of one of the best resource investment returns of all time.
I understand. A quick way of summarizing that would be is, as Rick says, I agree with this completely. If the reason why I own a stock goes away, I sell. I'm merciless in that regard. A very high-profile example recently. But the price fluctuation is never the reason.
Right.
The reason is, what is the company doing, blah, 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 blah. But the price fluctuation is not the reason. Excellent. Thank you so much.
Pleasure.
Pleasure teaching.